Very few people who have partner email IDs.
I know. I'm still. I usually use it for.
Or some have Yahoo.com. Like that's also.
Yeah, I have Yahoo. That's
yeah,
my
yeah.
thing. I think I put it on other slides too.
Introduction was your introduction,
Yeah,
and then the lecture one, and maybe also the outline. We can transfer to the outline as well.
Okay, we have lecture one. That's
Yep.
PDF. Okay, so that we can upload that. But don't you have a PowerPoint to?
That's the PDF.
PDF. We don't have PowerPoint. PowerPoint is easier.
Okay.
So introductions is PowerPoint. Lecture one. Those are the only two.
You do the outline and then lecture on introduction.
Maybe this one.
I don't know if you put in your photo. This is this.
This is the.
You can just put it over here.
I'll do this. You can have
This and then I can start it out.
Let's keep it there.
I had it sure. I saw your PDF. I was sure. Okay, so I did not know. Because I did not hear PPT. Maybe I can notice. Nobody can hack this.
I don't know. That's what I'm saying. I don't know why I got this. They gave me this coded thing that I need to fix that.
This reminds me of getting back to my business school. Let's take me now.
Where do I do password? Very complicated password. Good. That's awesome. It's surprising, shocking that actually worked.
So what backend with it?
There's
Oh,
keep
fine.
walking, you'll find the.
Okay, alright.
So guys, these are 3-hour classes. Do you usually lectures teach all 3 hours?
Yes.
Really? Will you be disappointed if it's not 3? Okay. Well, this is fun. Well, I'm gonna do this game. Okay. This looks like a good event. Do you guys know how many students are in this class? 18?
Yeah.
Yeah, they haven't added me to Husky yet, so I don't have access. Husky CT. So I can't tell anything. Yeah.
Because last semester I was including some graduate from UConn incentives. CC incentives.
Yeah.
So, what's the most common?
Because
22?
Yes.
No, for the summer course. Oh, that's pretty
Ah.
significant. Alright.
So is it like students take like it's part of a class or they take this as an elective so they can pick up?
No, it's all.
It's a required class.
It's a mandatory, so there's no elective. Oh, that's it.
Yeah.
This is the only time you can take it.
Yeah, it depends, like especially for the summer semester, some might decide to go on break. Yes.
Then they can skip. But otherwise, everyone takes the same course.
Yes, yes.
Okay, that's good.
No, I was teaching another course, the ERM course, and they cancelled it this summer. For some reason, there were not enough students enrolled for that. So I'm teaching in the fall.
It's a master's program.
Let me see. Let's start the games and see if that works. I sent it one student, that's great.
Should see here this week.
Very good.
Okay.
Are you recording with your other computer? Are you
Yes.
Oh.
I was putting in my aunt's like friend's home, and then she's also listening the meeting. So she's not really recording.
Can't you share the slide?
What?
What?
Can't you share the slide?
What slide? The meeting slide?
Yes.
Oh yeah, I can ask him to like share.
The slide was shared?
I can ask my friend. Let me double check.
Yeah, because I sent a message for the slide to be shared. And I have not. Is this
Yep. We'll start with this.
Yeah,
Are you?
I'm listening, yeah.
Okay.
You have to do it.
But that'll go up.
But we don't need it.
Okay, we have
The
4
professor
minutes to get
said
some-
like he will share the slide. The professor said he will share the slide.
Okay, okay. That is good.
Did you register?
Yes, I was
Okay.
in there.
I wasn't. I put my computer to my friend's home and asked her to record it for me.
So how many credits are there in this program, master's program? How many credits you have to take?
Oh,
It is.
6 years.
And it's a 1 year or 1.5 year?
1.5
One
year,
and a
but
half year.
you
4
can-
semesters.
It's 4 semesters.
Yeah, normally 4 semester, but you can take the 5th semester.
Take the 5th semester if you want to.
So you can this? What did you say?
I said if you want, you can go for the 5th semester.
Okay,
Yeah,
that's
but normally it's 4 semesters.
4 semesters.
By the way, did you guys know like for the AI meeting they are being asked for like separating into group and do the project?
Which one?
For the AI meeting. My friend just said they are separating into groups and
Yeah.
doing some project.
Oh, right now?
I don't know. I don't know if
Yeah,
right now.
that's what he said. He will separate us.
A breakout room.
guys, can you hear me? Hello? Yes, I can. I'm a little bit limited because anyhow, I have a class also, so I have a limited. Is there a syllabus you are publishing?
No, we cannot upload because I don't have access, but I'll do it after the class too. Yeah, I have a story to tell before we start. This is a weird class. No, we will upload it later tonight. I believe they were going to give me access today around noon, but it didn't happen.
Didn't the emailing for this done? Still not working?
No, it's not. Let's see this one. It's 7:01, so there's no. Okay. I'm gonna give it a couple minutes. Okay, one more minute and we'll start.
Yes, I can. Can someone share the screen and open the Copilot? Because I'm also at the. Yeah, I would do that, but I'm at class also at the same time, so I have to share my resources. So whoever doesn't have a phone and it's not me, can open Copilot and share the screen.
Yeah, that's good.
Yes, you do.
Yeah, on you maybe and on the other.
Yeah. All right, good. So let's start. So guys, I told you this is a weird class. There's a big weird story around this class. I was not supposed to teach this. On Wednesday last week, got a call from UConn that the lecturer is supposed to teach this 5 sessions, flagged for some reason. He couldn't teach. They called me and said, can you teach it? I said, what's the syllabus? What's the course? And they gave me the name which says applications in ERM. I usually teach the ERM course here and another course. I've been teaching in Columbia for 7-8 years in their master's in ERM. I don't know, I'm not very familiar with your UConn courses. So I asked them what course is it. They said, we'll send it to you in a couple of days. And they said, but since there's no time, we're gonna put you on the course. I said, fine, do it. I mean, I can figure out what to teach. And on Friday, or no, Thursday they send me, and it turns out to be counterparty credit risk. And I'm like, that is something that I'm not familiar with. I mean, I know what counterparty credit is. I'll give you my introduction and then I asked them, well, I'll find somebody who can teach counterparty credit risk much better than I can. But they did not have the time to onboard this dude, and so they said, you be the person on file, and both of you can teach together. So that's how this whole thing happened. This was all on Friday, and Tuesday we're here. They still didn't give me the Husky CT access to the class. Hello. And it's only 5 sessions, so he will be your real instructor for the syllabus, but I'll be your instructor on paper. So it's a very weird situation that we're trying to mitigate. Now, let me.
Excuse me,
Yes.
I don't know, is it also online or not, but maybe it would be useful if you record the class.
Okay, I can record the class.
Attendance is kind of.
I can record the class, I think, but I don't know where it records it. Only one student requested to be, online, so I did it. But how do we record
It should
this?
be 20 something.
Record and transcribe, start recording.
You have any?
Everybody agree that this class will be recorded? Alright. Choose video and audio, English.
I just confirm. But I think if you record it in this computer, you have to like
Upload it somewhere in Husky. Can I upload it in Husky?
Yeah, before you close this computer, I think you need to upload it. Otherwise, you will like refresh everything.
Oh.
No, but the video, the recording need 24 hours to like,
Upload it.
yeah. I mean, available on the Teams.
Alright, look, if I don't have the Husky CT access, after the class I'll figure it out. I do have Husky CT access to other classes, I'll upload it there at least for now, and then I'll move it back to your class when I can. Okay, alright, so this is working, I think. Recording and transcription started by you.
She can hear us, right? She can hear us?
Yeah. What's the name? Tutran, can you hear me?
Yes, I can hear you, Professor. Thank you
Alright,
so
that's
much.
great. Alright, so let me.
Maybe the only thing is the whiteboard is not really visible.
Yeah, whiteboard is not really visible,
Fine,
so,
fine.
I'll see if I can get it to a different view later. Only, again,
It's okay. I have Cliff recording a whiteboard for me. Thank you so much.
alright, thank you. So, let's do some introductions before I told you the story, but I didn't introduce myself. I'm Prasad Kodali. I have been in the industry for more than, it says 25, but it's actually more, a lot more. I'll give away my age. I'm currently the head of non-financial risk for a Japanese bank called Sumitomo Mitsui Bank, SMBC. We'll actually explain to you what that means in a couple of slides, but basically, my history, which is not that relevant, but I'll give you a quick thing. I started the operational risk department in Morgan Stanley many years ago, 2005, built their operas program. I was in another bank for another 10 years, built their operas program, and now I'm in SMBC, built their non-financial risk management program. I also started the Masters in Enterprise Risk Management in Columbia in 2016. Built the courses, taught there for 7 or 8 years, and Chinmay asked me to teach here, and that's when I started teaching here 2 years ago in the non-financial risk or op risk or ERM courses. Again, I told you the story about how I got stuck with this. Now I'm a glorified Uber driver. Gurpreet here will be doing these 5 sessions, but I'll be here because that's the rule. And if you, for all practical purposes, I'm the listed instructor on the Husky CT, so I'll take care of all that stuff. Okay. All right. That said, coming to the topics. We call it enterprise risk, but risk management is broken into, this is financial risk and non-financial risk, right? Financial risk, you all know, market risk, credit risk. I'll talk more about it, but non-financial risk is an oxymoron. There's no such thing called non-financial risk. That doesn't exist in reality. What they did is a bunch of risk departments that nobody wants to manage, they put them together and they call it non-financial risk. But traditionally we call it operational risk management. Now, I would give it a different definition. If you start a bank, you do take certain risks to make money. I call them the preferred risks. You take market risk intentionally. You actually quantify how much market risk you want to take, if that's your business, to make a profit, or unfortunately loss in some cases, but that's a preferred risk. Same thing with credit. You extend credit to individuals or a firm, and you actually have a risk appetite of this is my nature of what I'm willing to take. I'll only lend to AAA businesses or whatever. You know, you take that and you take that risk with the intention of making a profit. So, you know, liquidity risk is slightly more complicated than the straightforward money-making market and credit risk. But that's how I would distinguish between non-financial and financial risk. But and what is interesting about these 5 sessions is this red part that Gurpreet, he'll introduce himself and he'll start teaching this part. But red part that which is called the counterparty credit risk is not a preferred risk actually. You don't really go and take on, I want to take counterparty credit risk to actually make money. It's a little bit of a outside the normal business on this side of the tree, where you do take trading risk, you do want to take that risk to make money, but counterparty risk comes with it. It's not a preferred risk. It's a risk that you have to manage. So ironically, it's got a lot of similarities to the non-financial risks in my world, but it is actually a part of financial risk. So it's an interesting part, and I am also, I know enough to be dangerous, but Gurpreet here is the head of counterparty credit risk for $2.9 billion bank. So no, $290 billion bank. Our bank is overall $2.7 trillion across the world, but America's division holds about $300 billion in assets. And Gurpreet here is the head of counterparty credit risk. So, because of all this fiasco, you got an upgraded lecturer. You know, he's probably the best guy to teach you counterparty credit in New York area. So, you got him for free. Literally for free. We're not paying him, by the way. You know, so Gurpreet, you can introduce yourself, and that's all. That was my lecture. Go ahead.
Yeah, thanks for sharing. So maybe kind of my introduction. So I've been with the bank SMBC. So in total, I have 20 years of experience. First 3 years were more in chip designing. I was a VLSI engineer. I wish I stayed there, where the market rally is today. I would have retired. But life took a different path, and I did my MBA, and then started at Goldman with my career at counterparty risk. So as what Prashad mentioned, there's market risk, credit risk, which was more traditional. But counterparty credit risk came after Lehman. That was a little bit more nascent versus all the other established risk types. And we will get into that, like what that means. But it's mostly as we started getting into derivatives, which was a big industry, this risk became very prominent after Lehman went down, right? Because the government came in, started infusing money in AIG, because they did not want the systemic risk to just feed into the whole system and blow up the whole system. It's like that nuclear. So that's why how they came in, right? So I manage currently the counterparty credit risk. So I started my career at Goldman, spent 6 years. Then I was hired by MUFG to build their whole counterparty credit risk practice in the US. And then 2022, I was hired by SMBC to build their counterparty credit risk practice. Right now, where we are now, as we have built this whole framework, this is going to go kind of global. So that's kind of a quick introduction. I will have more opportunity to interact with you. Maybe if we can go around the room with like people and understand what you have done in your undergrad. 1, 2, why did you take this master's? And what do you want to do after this master's? What kind of a career are you looking at? That will give me an idea and help to put that kind of into as we start going through this program. So maybe we can start.
Okay, thank you. My name is Pedro Kanzel. I did my undergrad in accounting and finance. So my interest area is into portfolio management and asset management.
Thank you.
Hi, I'm Gokul.
Gokul?
Yeah. I did my undergrad in BCom and accounting finance. I was very interested in doing some CPAs, accounting things.
And so after this master's program, you want to get into accounting?
Hi, my name is Leah Medina. I did my undergrad in finance with a concentration in corporate finance. In undergrad, I was an intern for a pharmaceutical company. And then after this program, I'd like to go into like audit and financial and operational risk management.
Thank you.
That's my field. Are you taking my class in? I guess.
I'm done after the summer. I'm an accelerated student. So
Oh, so you didn't do my class at all?
what number is it?
It was supposed to be this summer, but They canceled it.
Oh, 5344. I was supposed to be, but now I'm doing an independent study because I was the only student registered. So-
That's exactly why they canceled it.
Yeah,
I guess.
so I'm doing an independent study now instead of taking the class in the
I'm
fall.
teaching it in fall. If you're around, you should log in anyway. All right.
Thank you. Leah, you said.
Yes.
Yeah, hi, my name is Phung. Phung.
Cool.
Phung. Yeah. My undergraduate is about accounting and auditing minor. But I'm start working as in corporate finance for many years, and then I take this master program. Again, I think I'm for more about the non-financial risk management because that's more my strength and my interest. But for the financial management risk is also, I mean, that's the thing many people do it. I'm curious, of course, yes. So that's why I'm here. Thank you.
Thanks, Fun.
So will you be graduating this summer too?
No, I still have 2 semesters going.
Oh, so you will be taking my class in the fall.
All right.
All right.
Yeah.
All right.
Thanks, Fun.
I'm Cliff. I'm the non-traditional one here. My undergraduate was chemical engineering. Then I went back to graduate school later on, did chemical engineering for graduate school. Designed a biodiesel reactor that I got UConn patented, and I've just been taking graduate degrees since then. This is like the 8 or 9 or 10 or something like that. I just keep my brain working.
Wow. Thank you.
My name is Pivia. So my undergrad was major in finance, but basically I think it's like mainly focused in banking and like crypto asset. So I used to have intern in like say banking SMBC, but it's in China, but that's a long time ago. And also have intern in like Shanghai Pudong Development and one like insurance company. So actually my goal is to become an actuary.
Got it. And your name was?
Pivia.
Pifia.
Pythia.
Hi, my name is Peter Warjager. Originally I graduated as electrical engineer slash computer science. I worked for actually a software developer for internet brokers. Did my MBA here at UConn, and then I started this program to get deeper knowledge in finance.
Okay. Well, we both share the same background. I'm from electronics engineering as well. Peter.
Yeah.
Thank you, Peter. You can go down.
I am Punyam. I did my undergrad in mechanical engineering and did my MBA straight after that in business analytics. And I worked as a product manager at ICICI Securities. I mean, you guys would know probably the bank. So I worked there for 2.5 years and felt like if I need to get into finance, I needed a master's after that. So that's why I'm here.
Okay. So you have a 2.5 years experience.
Yeah.
And Punyam.
Punyam. Yeah.
Thank you.
Hi, my name is Alexi. My undergrad was, I have prior work experience in the military. Then my undergrad is I have history, I have financial management, so like portfolio management, all that stuff, quantitative finance. I have a couple of minors too. I have like 250 college credits. I'm kind of like here. I was just taking classes for fun. I didn't even postpone my graduation. Then I worked as a data analyst at ICAP, like a private equity company. I'm doing this because I really started falling in love with like portfolio management is what I really wanted to do, and or aspects of it, like asset management, for example, which is credit risk, some of it, right? So, but I also started liking like quantitative finance, like financial modeling, like in Python and building stuff. Logs. So Pythia, we work together on some projects. Thank her. She's smarter than me, and I'm learning from her. But that's pretty much it. Yeah.
Alexi.
Alexi. You can call me Alex as well. That's easier.
My name is Carlos Chavarria. I did my undergrad in business administration with a concentration in finance. I did the master's right outside of undergrad because I kind of wanted to cultivate more like quantitative skills than what I got in undergrad. I'd like to end up after this program maybe like as an analyst at a hedge fund. That would be like a dream.
Good. Thanks, Carlos.
My name is Mateo. I got my undergrad was in sociology and finance. One of the reasons why I'm taking this master's is because my favorite class in my undergrad was financial risk management. My professor actually recommended me to this program. So that's one of the reasons why I joined, and I'm looking to get into become a credit analyst maybe after the
Where did you do the undergrad?
Southern Connecticut.
Oh, Southern Connecticut. Oh, okay.
Matthias.
Mateo.
Matthias.
Mateo.
My name is Frank. My undergrad major in business administration. I'm currently working in finance department of Furniture Company, and I hope to be a career in accounting and valuation.
Thank you. And thanks for the introduction. I think that's very helpful. So maybe what we can do, we can get to outline.
Oh, yes.
Yeah. So let's tee up, like in terms of if you can go down, Prashant, on the course description, please. So maybe just to give you guys an outline, what we will cover in this course. Again, I know this is 5 classes, and I want it to make more intuitive for you versus just knowing the concepts. So what we will cover, so I have 2 main objectives out of this program. One, you guys really have an intuitive understanding of counterparty credit risk, because if you go up, like anywhere, you can talk at a high level and connect with people what counterparty credit risk is. Everyone will know market risk, liquidity risk, credit risk, but counterparty credit risk, there are very few people because it came very recent after the whole Lehman. Because earlier people used to confuse with market risk, some people say credit risk. My objective is for you guys to have you like pretty strong fundamental what counterparty credit risk is. So that's one. 2, if you guys end up choosing a career in counterparty credit risk, you should be able to walk the talk. You should not feel out of place if you get into any bank, any fund. You should always understand what it means. Like, and you should not have a big transition to get into not knowing. So we have a lot of interns that come in. So one just started today. So they especially come for CCR. And my main objective is, guys, one, you need to fall in love with the subject, because once you start falling and feeling the concepts, then career becomes like your passion, right? So you don't have to find a different passion. If you're following your passion, it becomes your passion, you will enjoy it. And that's what keeps me coming every day at work. I think we spend 14, 15, 16 hours every day mentally. But what makes me come the next day is to be better in what I do, and I have passion for this particular field, because this is what I kind of breathe on a day-to-day basis. And my introduction to counterparty credit risk was pretty interesting. I came with an undergrad in electronics, it's chip designing. It was funny how I got to an MBA. A friend of mine stayed with me like back in India, and he was interviewing for an MBA program the next day in the Indian School of Business. And he said, oh, you know what, MBA is a good stream. And just one night he stayed with me. Next day I enrolled for, like next 15 days I thought about it, I enrolled for GMAT. And next year I came here. So what I feel, life is very accidental, right? You need to be staying open with those opportunities, because if you catch those will define your next 4 or 5 years, and then you stumble on something else that will define your next 4 or 5 years. So that was my first thing getting into MBA. Came here, 2007, the whole crisis blew up. I said, okay, we need to pack our bags, go back, and I was in Simon School of Business, University of Rochester, if you guys don't know, upstate New York. And a lot of we were communicating with our alumni, and every email I was sending, it was coming back, right? Because those people were no longer there, right? So I said, okay, that's a good time, I think let's learn. And then maybe I was trying to say, you know what, 6 months is good enough, I can go back now, I'll save some money, not spend everything that I earned, and let me hedge my bet and get back to my job, because if I stay here for 2 years, nobody will take me back. I will become redundant, I will forget what I did. But luckily or unluckily, I stayed here, got my internship with Goldman, and that is when the whole Lehman started going on. My last day of internship was September 2008. Like 19th September, I still remember, because that is the day when Lehman went down. That was my last day of internship. I did not know whether I will get a full-time back, like when I come back, whether my internship will get converted into full-time or not. Luckily, I got my internship, like my full-time, joined Goldman back, and that is when this whole new field started coming in, counterparty credit risk, right? People started talking about, hey, we need to start pricing this, we need to charge the client this counterparty credit risk so that we can hedge it out. Right, and we can also start because when Lehman went down, nobody knew who's facing Lehman. As that went down, $600 billion assets went into bankruptcy. Now, whosoever is looking, Lehman needs to pay me, yeah, be my guest, get into the bankruptcy lane, right? So if one goes down, everything else will start going down slowly, and that is where regulators came in. They said, this is systemic risk. Like, we cannot afford one counterparty go down take the whole financial system down. Based on Lehman, and when it came to Merrill Lynch and AIG, government chose infusing money into AIG because they thought if an insurance company goes down, it's gonna cause catastrophic, right? They had to choose, and then they brought in Bank of America, take Merrill Lynch, we will try to save AIG, let's save this world. They give $10 billion to each bank, and let's take this top money, stay afloat, like how COVID, the government started giving money to people, said just keep on paying your people. They gave $10 billion to all these banks, take this money, even if you don't need it, keep it with yourself because we don't want you to be the next Lehman, right? Keep it, and when you have enough money, give us back, right? So that is how this whole counterparty credit risk started coming into the forefront in 2008-9 because of Lehman. And then there are a lot of other events happened, like RKBOs happened back in 2021. You can see that the magnitude of that, like UBS has to come over and absorb credit risk. And it was just one counterparty going down. The whole bank goes down. You are suffering a losses of like $5 billion, right? So that is where like this thing becomes pretty kind of scary, and that's why I think what I want to cover is for you guys to start feeling what counterparty credit risk is. Right? And we will cover quite a bit of things which can go down. Right? So we have 5 lectures. So what I want to do, like in terms of objective, like explain the fundamental of counterparty credit risk and distinguish it from why it's different from credit risk, market risk, to also try to understand how practitioners calculate these exposures. If I'm saying credit risk, how much loss they can have, I need to know now because I want to sign off at that risk. As a CRO, he want to sign off because he want to know what that risk is. And that's the beauty of counterparty credit risk when we get into like why this is so uncertain, why stochastic models come into play, right? So we will talk about that. Then we will talk about how you can mitigate this risk, right? So risk cannot be eliminated. It can only be mitigated or reduced, and it can be only transferred. Either you are taking market risk, if you want to hedge it out, you have 2 counterparties. You can only transfer risk, right? So you want to transfer it in a controlled way, which you can also absorb, right? Then we will also talk about how the bank started charging counterparties for this counterparty credit risk, right? So if I'm going in and giving loan to someone, I will give at a better rate to someone who has a better credit versus somebody who doesn't have the better credit. I want to charge them more because then what I will take that extra premium, go buy insurance on those companies because I want to be neutral. So that's the whole concept of how you started charging the counterparty CVA, credit valuation adjustment, right? And then we will talk about, and the 5th, where I will talk about how as a practitioner we apply these concepts in day-to-day basis. And I think that's where I want you guys to get a feel. If you land up in a role after this master's program into risk, like you can be educated, talk about that to someone, right? And this is more like where, and in the banks, if you would see, credit risk is where you have to extend money. You have to give a lot of capital to generate 2 or 3%, right? Derivatives is where it's a very light on your balance sheet. It generates huge risk, but this is like magnified losses if it comes that way. So managing this is important. So I think that's what we'll cover in 5 key course objectives. Any questions? Okay. So, Prashant, can you go to the slides?
Yes.
And we will keep it light today. I don't want you guys to sleep over here at desk. We will keep it light, right? So let's start with a house flip example, right? Let's say I'm a real estate investor and I enter into a purchase contract with Cliff, right? So let's say I agree that I will buy here a house from you in 6 months. We enter into a purchase agreement. In 6 months, I will pay you $500,000 and you will like sell the house to me, right? Now, starting today, you don't know what the price of the fair market value of that house will be in 6 months. You just know now, it's 500K, right? You have 2 scenarios. Let's fast forward 6 months. You have 2 scenarios. One, the house goes up into 600,000, right? I lock that price, 500K. We enter into a legal agreement, a financial contract for 500,000. I'm up $100,000. Scenario 2, the house can go down, and let's say now it's worth $400,000, but I still have to pay Cliff 500,000. I'm like, I've lost 100,000 because if I now go into the market and flip that house, I'm not gonna get the money which I'm putting on, right? But There's a legal contract. So, a couple of questions. Did the value of the contract, so if I enter today in 6 months, did the value of that financial contract change?
No,
Why not?
because I'm still obligated to give you a house, and you're still obligated to give me $500,000.
Yes. So that is the terms of the contract. Contract did not change. But whether I am in the money,
But the value could change in your perspective.
yeah. So the value changed, even though the contract, so that's the second point. The contract did not change. I still have to pay you 500,000, but I'm in the money. Right? In the second scenario, you are in the money. You locked in a good price. Right? The worth that home is worth 400,000 in the market, but you have locked in 500,000. That's like when you get into markets and short. The reason why you short some stocks because you think right now they're overpriced. Let me lock this price. Later on, I will buy at a cheaper price and sell it back. Right? So the value of the contract did change, but the contract did not change itself. Right? But what made the value of the contract change?
Market conditions.
Exactly. Right? So as the market moves, demand and supply moves, whether that's because of interest rates, more people coming in, they have like stock markets appreciate, they have additional cash, the markets change. Right? So let's go to second step. So let's say in scenario one, when I was in the money, I'm going to give Cliff 500,000 and he's going to sell me the home, but the house is worth for 600,000. What if Cliff comes in and says, I have filed for the bankruptcy, I cannot sell you anymore?
Counterparty credit risk.
That's the obligation I've created. So because now my financial contract is worth like $100,000 more, right? What I logged in as a profit, now that evaporated. There's nowhere there, right? So this is like, oh, I have two stocks. One stock, I'm up 50%. Another stock, I'm down 30%. But this 50% now becoming zero. I'm net 30% down. So what my asset was, that is a total write-off. I don't realize that profit, right? Now in scenario two, like let's say if it was worth 400,000, like I'm out of the money, Cliff is in the money, but if I tell Cliff that I had big losses, I don't have this money to pay you, right? So now he has risk to me because there's an obligation for me to pay him 500,000 for something which is worth 400,000. He logged in a good price. And he knows, like if he would have sold now in the market, fair value, it would have been $4,000 or $100,000. But he had a good price, but I cannot pay him. So all that, like that is where like this becomes critical. But did we know at the start what the value will be in 6 months? No, right? In both scenarios, what's the biggest risk? Like in the scenario one, like in scenario two, what was the biggest risk? Counterparty not meeting its obligation, right? Because there's an obligation that has been created. In one scenario, Cliff owes me money because my contract is $100,000 more valuable. In another, like I owe him money, right? But at the start you don't know. So if you will say there was a financial contract, at that time you did not know what will be the value of this contract in 6 months, right? So because the markets can change. 3, based on the market changes, there's an obligation that's created. It's like a bet. You get into like any bet, you don't know what that bet will be worth. But what when you win that bet, somebody doesn't pay you. Right? So this is where markets create uncertainty because sitting at that point, you don't know what that value of that fair value will be in 6 months. And once that obligation is created, somebody doesn't pay you that obligation. That is what counterparty credit is. Right? Somebody owes me money, and you did not know that on the onset. Credit risk is simpler. You will know. I know I give $100,000 to someone. I know what he owes me. In this case, I don't know what somebody will owe me. Number 1, because the markets are changing. 2, based on that, there will be obligation created, and you don't know if the counterparty will be willing to pay you that money. So do we know? Do we understand what counterparty credit is? Very high level. We will translate into financial language, but I wanted to start with a house flip because all of us can relate what that simple contract would be. can go to the next slide. So let's translate this very simply. This example of house flip to financial markets. Right? So as a bank, I was the flipper, right? I was the real estate investor. Cliff was a house seller who was a counterparty. Okay? Now, rather than having a house as an underlier, let's say we enter into a FX forward contract. Me and Cliff back again. The same example. Let's say I agree to buy $12 million from Cliff, and I will give him 10 million euros. Right? So I'm going to buy something in USD. He wants to buy something in euro in some other country. We enter into, because we both have needs, we enter into contract because we don't know how the market in 6 months will change. You know what asset you are buying in euros. I know what asset I'm buying in USD. We agree like, okay, based on today's price, I already know what is the forward price, what market is telling me. We enter into contract, say, I will buy. Cliff will give me about 1,200 million USD. I will give him 10 million euro. Okay. Now, in this whole example, your house earlier, which was underlier, which was going up and down. In this case, the FX rate can go up and down in 6 months. Right? So that's a simple example, like how the underlier is changing because the market is changing. Right? The flipper and seller, now you are talking in financial language. The bank and the counterparty. Right? So for the flipper, the house seller is the counterparty. For the house seller, the flipper is the counterparty. Right? So it's both ways. Right? Then there was a purchase contract. In this case, you have a derivative contract. House price changes, FX rate changes. Now that will create gains and losses, right? As FX changes. So let's say today, when we contracted, it was 1.2. That's why how we got to 1.1 euro is worth $1.2. Right? So 10 million euros is worth $12 million. Right? Now let's talk about again two scenarios. We had two scenarios where the house price went up and down. Let's talk about similarly what happens in the FX rate. Let's say the FX rate in 6 months, scenario 1 is 1.10. Right? So that means if I go into the market today, if I have to buy today 10 million euro, how much it will be worth? How many USD?
1.1.
11 million.
Yeah.
Right? 11 million. Now, but I agree, like based on the contract, I'm getting 12 million. Because I agreed into that contract. I don't, like today, 6 months, it changed. But what that means is I'm in profit for $1 million. Because if I had to go into the market today, I would have only gotten $11 million. But I'm getting 12 million because I locked that price at a time. Right? Scenario 2. Let's say euro appreciates and the FX rate go to 1.3. Now, for 10 million euro, how much USD I would get if I get the market today? 13 million, right?
13.
I could get that 13, but I logged in 12.
Yes.
So I'm at a loss. I wish I could rewind back and take that contract off, but I can't do that. I'm on a legal financial contract, right? So we did not know at the start of 6 months which way euro will move, right? But as the euro moved, it created obligation for either side. It's very similar to you try to bet who will win this soccer World Cup. You don't know, but as you start moving through those rounds, Super 16, getting to quarterfinals, those odds start increasing. But starting today, I did not know. But the odds, and you start getting more money if you have put in on a weaker horse, kind of a person who like the country who can't win, the odds will be higher. Now let's again talk about in this financial contract, which is a derivative contract. Do we think the terms of the FX contract changed what we agreed at the start?
No.
No, it stayed the same.
Fixed, that's it, it's a deal.
Right? What caused that contract we had to gain or lose value?
Volatility?
Market.
Markets, exchange rate. Now, at the inception, did I know whether Cliff will owe me in 6 months or I will owe Cliff?
If you would have known, you would not made that deal.
In hindsight, is beautiful, right? Like
It's
you get into
gambling, right?
Nvidia. If I think now, I go back to 2017, I would have bought Nvidia. I would have retired by now.
Like, who knew that, for example, what's happening in the Middle East happening right now,
Yeah.
right? And it'll cause the European Union, suffering like economic downfall, right?
So standing today,
Yeah.
you don't know what's going to happen. And that's where we'll get into the second lecture. We start talking about when you don't know what's going to happen in the future, how do you forecast these things? You run stochastic calculus. Right? Because you will say, you know what, I don't know, but let me run random paths and take the worst case scenarios. And so we will get into those concepts later, like as we get into further lectures. But today, at the inception, nobody knew who will owe. So that's where, like, how, if we get to the next slide. So now let's talk about risk in this scenario, right? So let's say 6 months later, only scenario one happened, right? Where FX, so it was like what we talked about was now in the market, if I go, the exchange rate is 1.10. What I contracted, I was going to get, like, I'm getting 12 million US dollars, and Cliff is going to get 10 million euro. In market today, it's worth less, but I've locked in $1 million profit. What could go bad? What could prevent me to realize that profit? Let's talk about what risks. So when we get, so that's the beauty of this. Like once you start getting to derivative product, each product is different, and you need to understand what risk is there, so that you can manage it better. So let's talk about it. And the hint is, like at risk one, what could be your first risk that could prevent me to not realize the profit that I made from Cliff?
Drop in the exchange rates.
Right?
Drop in the exchange rates. A drop in the exchange rates.
Yep. But what kind of a risk is there? So that's market change. So now let's say scenario one happened. Market already changed. Right? So if market has changed, what can now, we already know now what the price is. What can go wrong now? Where like he owed me 1 million.
I don't want to pay you.
Yeah. That's risk number one. Before settlement, Cliff comes and say, I'm not gonna pay. Go whoever lawyer you want to call, I'm not gonna pay you. Okay? That's like before settlement. But what could be another risk in this case? So there is one, you don't pay me. Right? Whatever I made, I did never realize those profits. Those were like paper gains and they were evaporated. As soon as Cliff called me and said, I'm not gonna pay you.
That's part of what I'm not going to pay
Yeah,
you.
that's the first one. He's not paying me. What could be another risk? Which could be even bigger than this. So that's
Like, instead
already-
of not paying, like what's the other risk would be? Like maybe not okay because we're not getting that money. Maybe we're now in trouble as a company. We can go bankrupt.
That's systemic risk.
That's systemic risk.
Because if he goes down, I go down, I bring 5 of that down, we all go down together.
Yes.
So we all feel happy that everyone is going down. That's called sadistic pleasure. We are all going down. Nobody's going up. Right? But what could be another bigger risk? What Cliff just said. He doesn't want to pay me. But what could be even bigger than this? So in that case, I'm only losing $1 million. Right? Cliff is, because if I go into market and I'm about to buy now, it will be level million. I can get. What I'm losing is 1 million.
What if that 1 million prevents you from other deals?
Yep, that's a systemic risk,
Okay.
what Alexis said. Because if you don't meet application, I may be in trouble because I was relying on this to pay for my bills, to get my soccer tickets, World Cup tickets. I can't buy those. Any other guesses, thoughts?
Would it be interest rate risk, or did we already say that?
That's already in the FX rate.
It's already in
In
there.
FX rate,
That's
you're already
already
taking
pretty
interest
much
rate parity. That defines what that FX rate will be.
Okay, please, professor, let's do just say it.
Go for it.
Huh?
Say.
I want to hear it. I want to hear it now. So it's like, I don't think nobody's gonna say. I think
Enough
everybody's
suspense.
gonna
Okay. So what if before Cliff calls me, I send him 10 million euro, but I never receive my 12 million USD.
So you lose the
That's
notion.
even bigger risk.
I lose my whole $12 million.
Yeah.
That can happen during the settlement. Like Cliff can choose to stay mute, right? Saying, oh, like, you know what? Why I call this guy now and tell him I won't pay him 1 million when I can rip him off for $12 million?
Checks in the mail.
Yeah, it's coming. So that's even bigger. but that is for a very short duration, right? Because he can call me even 3 months into the contract, 4 months into the contract, hey, let's call it off, I can't do this. But what he choose not to do, but at that time when I pass the money,
Yeah.
which is very small time, maybe like few hours, then I send you the money, you send me back.
Would the bank it affects like the
the
exchange, forex exchange jumps in and like kind of helps to settle that, like so that stuff doesn't happen.
That's a great point.
Like interactive brokers, right?
Yeah.
They'll jump in and
Yeah.
do something
No,
like that.
the Delta Clearing House, this is a brokerage, so I mentioned
Yeah,
the
but if-
clearing house facilitates.
Yeah, that's what I'm
Is that
saying.
not-
You
is that
know.
not where the counterparty comes in?
Right?
Is that not where the counterparty comes in?
What do you mean?
Yeah, say when you're talking
We're
about say, one person
counterparties.
defaulting, and Alexi was saying, is there not a system that's
There is.
either the bank will come in?
Even the bank holds money in the
Yes.
pot. I used to work in banking,
Exactly.
so there's a
Yeah.
time for it to process exactly to avoid the the check like how was it when they there's a movie about that. I forgot, but with DiCaprio. I
Say,
think.
say one person defaulting, say like
You know
as you
what I'm
said,
talking
you
about.
send the money and Cliff didn't send. So
Catch me
is
if
there
you
not a
can.
party that will manage the entire transaction?
We will get to that.
Yeah.
So that's what we call as mitigation, how you will mitigate this risk.
Okay.
But the risk is there.
Yes.
So we will talk first like identification of risk. In this FX transaction, there were two risks. One, pre-settlement, where I can only lose 1 million. If we go till 6 months, maybe if he calls me in 3 months, maybe I may lose 500,000 because the FX has not moved that much. In 6 months, let's say that's 1 million. That's pre-settlement. Like in that, when I say pre-settlement, that means I have not sent my part of the money to Cliff, right? But during settlement, when I'm expecting I will send this, that's why like these banks have escrow accounts, right? Like when you do these house closings, they will say like they will release the money, a neutral party will release the money. So we'll get into all those mitigants, right? But a lot of this market is still over the counter, right? So this is the biggest risk, which is very short in tenor, like maybe few hours. But if it blows, it's like nuclear. It's gonna blow everyone up. You are losing $12 million versus 1 million. So now we understand like how we connected the house flip example with a financial example. Like again, in both cases, to start with, you had a contract, whether a purchase contract or you had a financial contract, number one. Number two, market changed. Right? In both cases, in one, the house went up or down, or in the second case, FX rate went up or down. Right? 2. 3, obligation was created. Based on the scenario, there was an obligation. You did not know at the start who will owe whom. But as you fast forwarded, an obligation got created. And now, the fourth is where you look at, is the counterparty willing or has the ability to pay? We will talk both, willingness and ability. Sometimes you can have willingness, right? I want to pay, but I cannot pay. Sometimes I can pay, but I don't want to pay, right? So willingness and ability. So that's where like whole this comes in, like bad actors who come. So, but again, 4 things are common. There's a financial contract. Number 2, the markets move. That creates obligation for one counterparty as you get into that 6 months. 4th, the counterparty's willingness to or ability to meet its obligations. Right? That's why you will say counterparty credit risk. Why it's more complex, because you never know at the start who will owe someone, who will owe who, how much it will be owed, and will at that time the counterparty will pull a fast one on me. Like in the second case, if Cliff says, oh, I take 10 million euros, like yeah, I can retire now. I don't need to get into these courses now. Like my curiosity is gone. I don't want to see this guy again. 10 million, I'm good. Right? So now we understand what counterparty credit risk is.
Yeah, so for the first example, real estate one, there is typically like 2 attorneys and an escrow account with Solvent, and for the like equity market, the DTC, the clearing house, which kind of tackles such a situation.
Even the escrow account will only solve for around the closing time.
Yeah.
You don't put 100% of the money into the escrow account till that last contract where you said the settlement risk can happen even before that. You can walk away even moving money to the escrow.
Yeah, but that this doesn't happen. I mean, that is, real estate is different, it's not one party pays and
Yeah.
it's slightly different, but.
No, but the concepts are similar.
Yes.
Over the counter, and is there a market, something to sell? Somebody who takes the
Yeah,
responsibility.
example, I just sold one house and the problem was there was something actually a lien on the property and others said like there was $17,000 and they wanted actually extra $63,000.
Yeah,
That's how it gets on. We
That-
sold it and we resolved the other thing, but otherwise it would be really difficult. There would
I know, in that case, it's more than just the financial risk.
Yeah.
There was the contract itself had some issues, there was a.
But we didn't know.
Yeah, that's fraud almost, but yeah.
And a lot when you start getting into contract, like if somebody doesn't pay, then you start looking at what was legal contract, let's bring the
Legal
parties in,
contract.
what are my rights, what I can call.
But at least both parties
So-
wanted the transaction.
So take this as an example. Prior to the financial crisis, CDSs were all over the counter.
Sorry, say that, who were?
CDS.
Oh.
Credit default swaps.
Credit default
Oh,
swaps.
CDOs, got it.
CDS. Were just some random guy saying, I'll insure you against that company. There was no market, there was no market maker, there was no, what do you call the settlements to be, what do you call the thing, like the, what's it?
Clearinghouses?
Clearinghouses
Yeah, they
for
all came
CDS.
after 2009.
They created the CDS clearing later, I can't remember the acronym, but anyway, there was nobody that promised you. And I would say, I guarantee something for you, and then get into that contract and then sell this to some party, then that party sells it to some party. When the default actually happened, you come to me, I'm like, I don't exist, I'm not holding your paper. Go there, and sometimes they couldn't even find the counterparty without any mediator there. So, over-the-counter deals exist even today.
And that's the biggest market.
Yeah.
That's the biggest market. And we will get to that. Right?
Anyway, so his job is that he has to deal with both types of risks. That's the bottom line.
So I come in every day, I look at my exposure. Because Prasad said, in the US, SMBC is lending close to $300 billion, right? And right now the derivative business we have is around 10% of that. But if you're doing a lot of lending, you're putting a lot of your balance sheet to use. Whatever I have in my bank, I'm lending. These are very asset-like, these are very asset-like. This is like options. It's not you're putting your full money to buy a stock. You're doing an option where the losses can be big, but the gains can also be big. That's why it becomes more dangerous and nuclear versus lending. Because in lending, you will know how much you're going to lose. And you can only lend what you have in the account. You're not going to put leverage on that.
I mean, you could, but
Yeah.
that's a different
Yeah.
story. Yeah.
That's for the next classes.
Yeah, that's okay.
So again, we talked about this, right? So this is a technical definition of counterparty credit risk. Right? So counterparty credit risk is the risk that a counterparty fails to meet its contractual obligations before or during the settlement of the transaction. Again, there was a financial contract. The value of the contract changes because market changes. Risk appears because obligation is created. And then counterparty's ability or willingness to perform its obligation is in question. So there are more things that are dynamically changing versus a loan. Okay. Can we go to the next one? So now let's do a compare. What makes this whole counterparty credit risk or derivative markets different, right? Most of the financial contracts, when you're taking loans, they're predictable, right? Let's take these two examples. Traditional loan. Bank lends company A $100 million at a floating rate. Let's say whatever the SOFR rate is plus 200 bips, right? Because I'm lending that 200 is my credit risk. That's like if you're getting to market saying, hey, what is the risk-free rate? 5%, 4%, and say if I want to buy the car, if they're giving it credit to someone, they will charge 1-2% more. Bips is just 100 bips is 1%. Right? 200 bips, 2%. So you're charging 2% more on whatever the published rate is. But do we know who owes the money at the end of the financial contract? In a traditional loan, do we know who owes the money?
Yes.
Who?
Yeah.
Borrower. Right?
The borrower.
How much of money is owed? Do we know?
No, because the interest rate floats.
Right?
Your interest rate is floating unless you fixed it.
So let's assume that SOFR is predictable for now. let's say a little bit more and up and down. Good point, Cliff. But let's say we still know it will be the principal plus whatever that interest will be.
Yeah.
Whether that's floating or fixed, floating will change as Cliff said rightly, but we still know it will be the principal plus the interest. And
What I
who
said
owes?
is covered in the third part, the exposure.
Yeah. Do we know the exposure today?
You don't really know that yet.
We know the biggest piece over here is the principal, because the rest is the interest amount, right? That can be, if you look at 100 million, if you say it's a 5-year loan, there will be interest payment, I agree, but the principal risk is the biggest risk in this transaction. Interest I don't get paid, I will be saying, you know what, give me my principal back. Interest I can care less, right? Right? But if you're saying my principal is in question, I don't want to lend you. Right? Now, in a derivative contract, let's say now we compare this traditional loan with a derivative contract, and the same example with the bank enters into a 6-month FX forward with a corporate client, like let's say this client is B. Do we know at this time how much money will be owed in 3 months, 6 months today? If I enter into 5-year contract, 6-month contract, do we know?
Not really, because you don't know which way the option's going to go.
Yeah. So we don't know that today. Right? So we just covered that in the previous slide. We don't know today, standing now, how much exposure will be there, how much value of the contract will be, right? So and do we know who will owe this money in 6 months? That's the first question there. So we don't know who will owe. We don't know how much will be owed. Right? In traditional lending, again, exposure is known today. In derivative market, exposure is uncertain. In traditional lending, usually it's one-sided. I'm the lender, we know the borrower will owe the lender. Right? It's one direction. In derivative, it could be two. You don't know how the market will move, who will owe at the end of 6 months. In traditional lending, as the principal will start coming in, some loan repayment, the principal will getting paid, it will start going down. What I started in for initially on 100 million, I will also, when I will start getting interest, I will also start getting repayments back. So I know the exposure will decline. But in derivative, you don't know. The exposure will decline or it will increase. Right? Because the traditional lending is driven by repayment as well. You can repay, but in this it's purely driven by market movements. Okay? So in loan, the borrower is facing the bank. So the obligation is always from the borrower to the bank, one-sided. In derivative contract, it could be either way. Which contract do you think is easier to manage?
Traditional.
It's easier to manage, right? Because you know the exposure, you know who owns someone. In the other case, you don't know how much will be owed and who will owe whom. So that makes now do we understand why CCR is different from a traditional credit risk? It's still credit, you don't know how much will be owed and who will owe. That's the core concept of CCR. If you go on the street, I've seen people yeah, we understand CCR, but when you start understanding how it's different, it's like credit, it's like market risk, right? But this is how people differentiate what CCR is. It's your credit risk because of the underlying financial obligation that can change over time. Any questions? Let me take a pause.
So are you modeling this like a 2-dimensional Black-Scholes type model?
We will get to that. That's a great question. So starting today, I will give you a preview. So starting today, I don't know how much it will be in 6 months. Right? So if you don't know, what will you do? You will say, you know what, I have a few ways. I can look at historically how things have moved and try to forecast how it could be in the next 6 months. Right? So you can do that. You can say, I know how the history has been. Right? Let me take a best guess how it will be. That's one way. Look at historical prices and you say, let me look forward and try to create that exposure. How much this person can owe me. Right? Similar, like if you enter into a soccer bet, you can try to say, if I'm putting a bet on USA winning, right? You can start calculating based on the path it will take, how much it will be owed to you. Right? So you can start doing that either using historical analysis, or what you can do, you start getting into stochastic calculus. Monte Carlos.
Monte Carlo, yeah.
You will try doing random walk.
Random walk.
And you will say, let me, you know what, let me throw 2,000 scenarios and try to calculate my exposure in each path. Then let me pick that exposure in 6 months, put it on the probability distribution, and apply a confidence interval. With 90% confidence, how much my exposure could be. That's like you take the historical bias away. You're trying to really doing a random walk. That's what the whole stochastic. I don't know if you guys have taken any stochastic calculus classes.
Yes, we did.
Right?
Last semester, so we talked about random walk, Ricard, all that stuff.
Yeah, so that's another way. You can introduce a historical bias. You can do purely random. Right? Again, and you can even look at like some other things, and we will get into that. We will get into what potential future exposure is calculated, what is average exposure, peak exposures, how you calculate all those. I will give you guys preview. Again, the intent over here is not to make you mathematically fully enriched. The idea is you get the feel of the concept. Like if you don't know today, starting what 6 months will be, what's the best guess how you will calculate? Because the objective of this class is mostly you guys having that intuition, because once you start practicing these things, you can do everything by hand or paper, but you can do these things. The objective of this class is to give you all the tools, so that you know if after you do a handyman job, you know all the tools, how to use it for plumbing, how you can use for electrician, you can do all those things. But the objective of this class is giving you all the tools and telling you how you can solve these problems, what tools you have in the toolbox that you can utilize. Okay, so now we know why CCI is fundamentally different from traditional credit risk. Let's go to the next slide. So this is Prashad's favorite slide, non-financial versus financial. Whatever is not people like. So that's how you see in financial risk. Historically it was credit risk and market risk. Right? Then in credit you can bifurcate this into lending, which is like loans, mortgages, bonds held to maturity. We already know what is the obligation at the end. CCR will be like trading risk, what we call in our language, in practitioner, we say lending risk and trading risk. Because in trading you don't know what would be your loss and gains. And it's all driven by derivatives. Right? Security financing transactions, we will talk about that. Then trade did, but not settled. So there are 3 different types of products that can introduce CCR. And we will get into that in depth. Right? So again, this is pretty fascinating, and as this thing. So I was today in a discussion. The SMBC hired someone to build the structured notes over here, right? And the way, and I will give you guys a practical, like how you get into new products and try to understand from fundamentals. Like, hey, this is a new product. Do we think there will be CCR? I will give you one example that I just like we were discussing today with the business, right? So we are looking to start doing some structured products. Right? So what it means is, generally people will come and buy, let's say, debt, right? They will invest in debt, they will give you 100 million, they will say, go buy the bond of this, that will pay you coupon, let's do income stream. Some also say, let's do structured notes where just not that 8%, let's try to build a derivative which will be linked to S&P. So that 8% can go to 12, 13, 14 as the markets move. Right? Now, I was talking to, I said, okay, so in this case, somebody is giving you money. So let's say I'm the bank. Somebody is giving me $100 million, and I'm looking to give them a market-linked returns. If market do well, it can go up. If market doesn't do well, it can go down even then less than 8%. It can be 5%, 4%, or even you can lose principal. But that is where people are saying, I'm willing to take this risk because that generates an income for me. Okay? So I said, like, okay, so you have the money. Now, the counterparty, and you took the money, you're fine. The counterparty, they have invested, it can go end up and down where the counterparty credit risk is, right? Now, as you start doing that, start structuring that, you also have to insert a derivative that will give you, link it to the S&P, right? Now, how you will hedge as a bank, you will go and hedge it to a broker dealer, another bank, because as a bank, I cannot take a directional risk. What I will do is I will say, I will give you structured note 8% plus market linked, But how I will drive that market link, I will go and buy it from someone else, an option. Now I have introduced a counterparty risk on the bank side, as that is giving me that option, number one. Number two, these things take like 10 days to settle. What if you came in and said, can you give me the structured note? I do that for you, and I put a hedge on the other side, but in 10 days you come in and say, I don't want to buy it. I still have put in the hedge, I have to pay the other person. You fail on your obligation doesn't mean I also don't pay in my obligation. Right? That is how you start thinking. Every product is very specific, like these structured products. So you really need to understand, if you have the basics right, and you can walk through, okay, so let's understand what this product is, where you're introducing, how you're introducing. That's the most fascinating part. Understanding the product, understanding the risk, and then marrying the two.
So this is, I just want to add, since you brought the new product, every time there's a new product, the business or the person who's actually coming up with the structured notes or hedging with the third party, for them in their mind, they actually know the structure pretty well. And when they come to the new product, they come in and speak about structured note and averaging it here and they walk away. We're like, no, don't do that. Show us the cash flows. So we make them draw even though it's the basic stuff, who pays what, but that's where you can actually see where the risk appears. And in spite of being in this business for 20, 30 years, we never assume anything. We make them draw the thing.
Yeah.
And sometimes they don't, and we argue like hell, but that example is really an interesting one because they just throw the word, we hedge it. Sounds pretty straightforward, but that introduces all these additional risks that you didn't intend.
When you make them draw it, that's how you know that they know what they're talking about in the
That's
first
how
place.
they'll think through it as they're drawing it.
And sometimes their intention is to dumbify it so that we can skip some.
Yeah, sometimes it's intentional. Yeah, you're right.
Intentional dumbifying it
Yeah.
so that we can't see the risk. And as a risk person, you have to be a greasy monkey. Everything should stick to you.
Yeah, and before the financial crisis, they didn't even care about risk management. So they just did whatever they wanted to. And now we have a lot of blocks in place so that they cannot do or execute trades without getting our permissions to do it. So that is where risk management comes into play. All right, sorry, I didn't mean to interrupt you.
Thank you. Thank you.
Yeah.
And I think that's where when you start getting into markets, that becomes more fascinating, where you learn a lot of new products. That's the fascinating part. Starting identifying risks, and after 2008, people saw what the magnitude of risk they are looking at, that can lead to companies getting evaporated. They can't afford not to think about that. And this is a discussion I was having. I said, okay, so he said like, this seems risk has evolved. Right?
I'll upload.
Yeah, but just I think just
The notes, yeah. You know what, from the next class, sorry, we'll upload the deck before the class so you can print and write and all that. But, like I said, this is a weird class. I've never been called to a class 2 days before the class.
So that's a fascinating, like, so today, he said, I've been doing this for 20 years. There was only one instance in the past 20 years that has happened like this. Do you really think we need to go and have this kind of a framework we're talking about and define the risk? I said, like, you can still go, run your car, like at whatever speed you want, but you don't want whatever money you made that goes down to zero because regulators have come in and given you a bigger ticket because and something blew up in your face, you did not even have a framework, you never thought. It's like starting buying S&P options, not knowing like how you want to manage that position. Right? So you can just say, I just put an option, let's see in 6 months. If I am lucky, I will get money, but people will start position managing those things, right? You want to cut your losses. Next.
You want to do a break or?
Yeah. If you guys want to take 5-minute break, 10-minute break.
Yeah. Do a break?
I don't know.
Yeah, I'm in. We have a lot of time, so.
So let's meet 10, maybe 8:20.
Yeah.
8:20.
Yeah, 10 minutes. 5-minute break. We can leave early.
it's a shame. It's at the same time. It's like
Yeah, like, I don't know why
Stay away from coronavirus. You should get sick. I'm on the back end, so I don't think I'm spreading stuff.
We can.
I was awesome. Already got interviews, so I'm kind of on a positive note. I literally got my ass handed to me today. Have you heard that phrase before? My ass got handed to me.
Your ass got handed?
Handed, yes.
Your ass.
You guys, I think I probably should be more professional. You should be, but this is a very good way to name. I got like put in my place, you know, basically. Like, you know, I thought I'm smart, but people proved me wrong. So it's pretty cool. So guys, like during the interview, it was pretty cool. The guy was like, of course, he was an Indian. He's probably math major or electric engineering, and his bachelor's. He's probably did his master's in finance. So he thinks, you know, and he's like, if circumference of Earth. Yeah, here we go. It's like, you know, there's like a string, you know, involving the circumference of Earth, and you add a meter to that rope. How much that rope will rise? Because you need to connect the ends. You know what I'm saying? So it's like this. You gotta like do it. How much the rope will rise up from like the ground surface of the Earth by?
Wait, is this your interview?
Yeah. For portfolio management, yes. I was like,
So because the Earth is spinning, that's the question.
no. Circumference of Earth, you have like a rope around it, right?
Okay.
Tight. It's like wrap your belly.
Okay.
Right? If you extend that rope by a meter,
Yeah.
how much the rope will rise from the ground? Because you gotta like, you know, because it just started became like that, so you gotta do it. So you see, rope was like this, you gotta add it. So now to do this, you gotta do that. So
But there is a gravity.
nothing but gravity. Mathematics. Like what's the distance? I'll put that in.
I mean, you have to.
I feel stupid,
You
man.
have to calculate
The length, right?
Yeah, the length, and
You don't have to.
Then you have to.
How do you calculate the length?
2pi times the half of the distance.
R.
Yeah, R, yeah.
So
2
they
pi
gave me
r
that question too,
circumference.
because I'll start thinking, and he's like, "What's the?" And I'm like, "Pi by R." And I'm like totally blank. It's like middle school math. I'm like, "Oh my god, dude!" I was like totally not getting ready for this. You know, I was like looking at capital markets. DCF. I was literally interested in like, you know, valuations. And he's like,
That's like assuming
you gotta
the original
divide
is X and then like original is Y.
divide 1 meter, divide by 2 pi. It would be 1.124 centimeters. So yeah.
Let me
Yeah, here you go. I'm telling
I want
you.
to calculate.
I tell you, my ass got handed to me today. I was like, oof. But he talked about logs, right? Log returns. So what would you pick log returns or regular returns? I'm like, they're normalized. Like that's easy. But then like, why would you pick standard deviation for like normal return? And I was like, they're normalized. And he's like, formula. And I'm like, man, you got killing it, man. He's like, you know, he doesn't.
So that's for a different company?
Yeah. I mean, I got laid off.
I wasn't clear to me. You were. You said you
No.
were-
I just said I got laid off. I got severance back and they still pay me. They paid me for only 2 weeks. The severance back. I'm like, okay, man. I'm just like, honestly, I'm not even upset. I was so busy. I was not even really applying. Now I'm like, and I really know what I want now. I'm kind of like more narrow now. But yeah, this interview was like, fuck, man. Like, it was, but I liked it was quick. It was only 1 hour, but it was 2 people, 20 minutes, and then 2 people.
Online, I guess.
Huh?
Online.
Online, yeah. So, but it's like, I don't like online. I like coming to the office and having person to person. I feel more comfortable with, I don't know, when it's like so like online, it's like in person, right? You know, the camera might give like, you know, so you get shitty camera, you know, it's like, but it's cool. We'll see. I think I fucked up. Like, it was a good experience. Those math questions, like, oof, man, I was like, but I think that, so because I totally failed that one. Oh, and he didn't ask about probability, about like red balls versus, how cool is that? See? But also they did the probability. Yeah, right. Which is red balls, blue balls in basket A, red balls and blue balls in like basket B. That's my probability. So it's easy, right? But, like, yeah. So it's just like, but I was like,
What kind of company now?
it's called, actually called Spectrum, but it's like a portfolio management. It's not the Spectrum, like the it's like asset management firm. I was prepping more like for credit, so like credit risk because they primarily trade in like credit of the company is important for that. You know.
So where is it located?
It's Stanford. Yeah. By the way, I just recently applied for the counterparty credit risk.
Oh, is it?
Yeah, it's funny. Like I was just.
I have this for you.
Yeah. I applied for
You had a PowerPoint, it didn't work,
I
but.
applied for 3 positions. I'm right now active. My company just did a mass layoff, so I'm like actively applying. So,
All right, you can apply with them.
Yeah, I already did. Like, on May 28th, I was like, what are the odds, man?
What, in SMBC?
Yeah, no. Yes, in SMBC, yes.
Yeah, I'm going tomorrow.
Sumichi.
So you actually applied for a counterparty credit risk job?
I actually swear I can show it to you right now. I have an Excel spreadsheet.
Did you get the resume?
I-
He's the one who's
No, they have an analyst position. I saw that, but it's trying to avoid as much as I can.
Wow.
That's the past.
You only go 1 or 2 days.
Really? So Chase, I have a couple of buddies working in Chase, and I went to their event. Oh, you guys didn't go. And they're like, talking to them. Now before I'm like, I speak with multiple languages. They have like foreigners, they have quants, which is pretty interesting. A lot of them foreigners from Eastern Europe, India, China, and I was like, we're talking about Garch, like logs, normalization, we're talking about all this fancy stuff. And they're like, then my buddy was like, hey man, just watch out. 5 days, they did, Jimmy Diamond wants them 5 days in the office. And I was like, oh man, like,
We all did that for many years.
Yeah.
It was like,
I don't know, Kate, the most valuable thing in life is wealth. You can't buy it, you can't sell it. And 3 hours every day on the train.
Where do you live?
Huh?
Where do you live?
Oh, Stanford here.
It's 1 hour.
I'm like 10, I used to, I live 10 minutes away from the train
So,
station.
you know what, 1 hour, like, I live in Edgewater near Portly. It's 1 year, like, door to door, taking the ferry takes me 45 minutes.
Really? It takes that long?
45 minutes. Because I will walk 10 minutes to the ferry
Oh,
station,
yeah, ferry,
take the ferry 15 minutes, then
yeah.
ferry shuttle will drop me another 15 minutes. It takes 45 minutes. Right?
Audiobooks.
My commute is.
Audiobooks.
My commute is 7 minutes. I walk.
Audiobooks are, I will plan my day. Because that is my own time, I will plan, hey, these are 4 things I need to think about. Right? So you can plan when you have this downtime. But I think as long as you are within 1 hour of commute,
Yeah, it's fine.
that's a blessing.
It is.
It's a blessing.
It is.
That's my kind of, if I want to stay at home.
I just got rotten spoiled because the company I just worked at, the mass layoff is probably, we outsource ourselves out. So I train people in the place, which I knew was gonna happen, but it's like I don't have time. So it's like waiting for some positions internally to move up and whatever. But I was like 5 minutes away. I could have walked like 10 to 15 minutes.
Sorry? You're a veteran.
Yes, I am.
So
Yeah.
which, maybe?
Army. Yeah.
I had when I was in Goldman,
Yeah.
the guy who joined me in counterparty crisis, he was a Navy officer.
Yeah.
So it was funny, I had
I'm joking. This is a competition,
It's funny, like, if you get a military person, an Air Force person, and a Navy person, and they're having a lunch, they have the problems of their own. Right? The military guy will say, you know what, I was in Afghanistan, standing outside the tent, my life was hell. Right? Navy guy will say, my life was hell more than you because I was in the middle of sea. Nobody was there. And then Air Force guy come, he says, my life was real hell, my TV was not working.
No, we joke like that all the time. We have a big one is like, in Marine Corps, they're like, they get upset when the water, doesn't have ice, Army gets upset when they don't have power. Air Force gets upset when they don't have cold power. They're like, so it's like, they actually, so I deployed with some of them. They're actually paying them. Oh, you stationed with the Army? We're gonna pay you $1,000 extra for partnership. I was like, that's messed up. I'm like, that's because you're stationed with us, you're getting more money. Like, just because you're with us, it's kind of funny. But yeah, I'm gonna grab coffee. I'll be back. We're chatting with you.
Where do you grab coffee?
Huh? We have a veterans spot. It's a special place. Sorry about that.
Because they close the cafeteria here. I don't know where to get coffee. Yeah, oh, Target has a,
Yes.
Yeah, Target has a
you gotta get
store.
out.
But I think it's already closed.
Yeah,
It's like really late.
yeah, it's really late now.
Congratulations.
So I need to remember the names. Gokul.
Yeah.
Cliff, I know now. Peter.
Yes.
I forgot again.
Pivia.
Pithia.
Yeah.
How you spell it?
P-Y-T-H-I-A.
Pithia.
Yes.
Pithia.
Well, Colombia had 60s.
I do it. That is
Eddie,
easy.
yes.
That is easy. Matthias. Matthias.
Yeah.
Matthias.
Yes.
Fong. Leah.
Wow, that is impressive. That's impressive.
I like it.
So in my Colombia, the classes were anywhere between 45 to 65, 70.
Oh, yeah.
Generally about 50, 55. And it was 90% Chinese.
Really?
90%. Out of the, if it's a 50 people class, there are 45 Chinese. A couple of Indian and then a couple of people locally.
To be honest,
So
in
it
my
took me
other-
10 classes to remember the names. 13 classes, and then the batch changes. The next 60 show up. So I had pictures, 60 pictures, and names. Our system this doesn't do it, but that actually produces that. So I actually made them sign the names with their English names, and I kind of prepared. First few classes I tried to learn everything. Then I gave up.
Sorry, I will tell you a funny story. So when I graduated my undergrad, so we used to have a professor in the class, and it was like classes were mandatory. If you don't attend 2 or 3 classes, you will not get the next class or semester. So, and people will do proxy. If somebody is not here, yes sir. They will be behind the badge, yes sir. And this guy was very sharp. He said, like he will say roll number 617, 620, 630, and somebody say yes sir. No, 630 is not in. He will know by the roll number. He was that sharp.
Yeah.
I said I can do minimum. I can at least remember names.
You don't have attendance or in-class participation, but I had to do a lot of those things. In fact, for 70 people class, every time they answered my question or they asked a question, I gave them a little token. Like a unique ID, and they kept it. End of the class, they have to give me back 5 tokens, they get the participation. So, yeah, thanks.
See what that? Carlos, Punyam,
Reese. Reese.
Reese.
Yeah, Reese.
R-E-E-C-E.
Yeah, like the candy. Or S. R-E-E-S-E. Like the candy. Yeah, like the
R-E-E-S-E.
candy.
Rizzo, the chocolates.
Yeah, the chocolates. Yeah, that's it.
That's why I forgot your name. It was little less.
Shop.
Sean.
Shop.
S-H-A-W-N.
S-H-A-O.
Shaw. S-H-A-O. Shaw. Okay. Okay. So we can continue.
All right. You have the ticker, I gave you the ticker. That doesn't work in PDF, but you can just point the things if you can.
So 1 divided by 2p, right?
Sorry?
Okay. So now we know why CCR fundamentally is different. We also know where CCR is. Now let's talk about why it matters. Like why after 2009 people started paying attention. Why it was so obsolete earlier. People never paid attention. Right? Let's go to the next slide. So we will talk it from 2 angles, right? One, we will talk about from market size, so that you guys understand if something goes wrong, what's the magnitude? Are you losing everything? Are you still saving something? And then we will talk about what people have actually lost. That will give you the magnitude of what could go wrong and what has actually gone wrong. Right? So you would see, so this is a derivative market, right? So, and I'm only talking about over-the-counter derivative, which is the majority. But you would see in 2025, how much is this? And this is read this. And how much is this? 850? $850 trillion market. Right? What is the world GDP? What is the US GDP? If this goes wrong, like 850 trillion, how many years it will take for the annual GDP of US to recover?
29, 30?
More, 30. So globally, it will be roughly 6, 7? 7?
Yes.
7 years of global GDP will take to rectify if everything goes wrong.
I mean, that is the notional though.
Yeah, I'm gonna come to that.
Yeah.
Because that's where we'll come to. But at least you guys know the depth. Why there's even this much notional outstanding. Like if you're saying this, so our portfolio in US is 300 billion. If I say globally, what is the derivative? It's in trillions. So there's a big market for derivatives. There's a big market for traditional lending, but now there's a very big market for derivatives as well. We will talk about like why there's market, but that's later. But what you need to take away from this is this market is big, and if something goes wrong over here, put that in context of the GDP, right? So it will be total, right? It will not be repairable. It will be your car is total, right? Now, out of this 850 trillion, which Prasad rightly said, it's the notional. What you're saying is, I'm getting into FX contract, let's say for example, $850 trillion, right? Just that's the notional. But we saw in the case where we talked about $12 million USD with $10 million euro, the risk was 1 million. So the notionals are big, but the risk based on how long it will take to settle, how markets can move, that will be a percentage of this. Right? So even out of these contracts, so $850 trillion, if only a fraction of these contracts become problematic, the losses can be significant, right? Even if you throw out of 850 trillion, you throw something, like you're talking about like trillions, not like billions, to lose, right? And if one counterparty does not, like as we said, if Cliff does not pay me, I don't pay someone else, right? And like this way, and maybe Cliff already did these like trades with 20 people, right? So he had like 20 houses, he agreed, and if he goes down, he does not pay 20, those 20 don't pay, can pay others. How much it will quickly cascade, like in terms of systemic risk. That's where the whole AIG came in. We can go to the next slide. So I will give you an example of what happened, and just 4, right? I think there are many, but I'm just gonna pick 4, which I felt were true game changers in the market, what made. The first one, LTCI. I don't know if you know long-term capital management hedge fund. Has anyone heard about it?
Every risk.
That's somebody telling me I don't know John Kennedy.
With LTCM.
That's somebody telling I don't know who John Kennedy is. In finance, like when somebody will talk about the first big losses we took, LTCM, long-term capital management. So read that, because that will be good to know, because you always remember things with like where, like what were the changing moments, LTCM. And it's a very, very fascinating story. These guys were partners who were doing this leverage fund that put some derivative bets, right? And at the end, they were even saying, give us like maybe of this fund, give us 10% back. And they had Warren Buffett on the line, and he gave them a deal. He makes deals, right? So he gave a deal. He said, I'm going to Alaska tonight, and if you guys don't take the offer today, I will not be available with my phone. And these guys said, like, this is too less. Even if we go to the market, we will get more. By the time they all agreed, let's take 10%, the phone was gone. Right? They could not reach Warren Buffett, and they lost big. The losses was 4.6 billion in 98. So do an inflation adjustment to today. Right? So where it will be. Lehman Brothers, this people must have heard of, right? Lehman, we know? Who doesn't know Lehman? Raise the hand. Nobody will raise their hand, right? So when Lehman went down,
just a story, I had an offer between Lehman and Morgan Stanley, and I took the Morgan Stanley offer.
Lucky. You felt it. I feel bad for the people that they're not as predictive as you are.
I mean, I probably got lucky. That's the word I use. Not really predicted anything, but go ahead.
So Lehman was one of the best, right? So when back in 2007-8, if people will say what 3 companies you want to work for in banking, there will be 3 names: Goldman, Lehman, Merrill. 2 of them are gone.
Morgan Stanley too.
Morgan Stanley, because Prasad joined. That's why, the 4th one. Right? But at that time, Lehman was so good. They were killing, like making killings. These people like.
Well, correct me if I'm wrong, like a lot of people say that the issue was not they didn't have money, it's liquidity. That was the big
But
issue.
why the liquidity squeezed? Because when like liquidity will squeeze if I will start having assets write downs.
Correct, but like remember that, you know, there's political risk, right? So Goldman got saved, you know, let's be honest, you know, because there's certain people in the White House.
Yep.
Whereas at Lehman they're like, you know, like they just dumped them. Because if they would have lended, if they had a short term.
That's probably true, but Lehman's leverage ratios were so bad, not compared to any other investment. I think they were 16 times leveraged or something, as opposed to.
But the short term, but long term, like if they had time to like their like liquidity, like get all assets like straightened away and get them like you know basically.
I mean that is true for any traditional. Even if there's a run on the bank, you can say, if there was no run on the bank, I could have survived in 30 days, right? That's the problem with the financial world is it survives on confidence. And you know, even at that time, I was in Morgan Stanley. We got a $50 billion investment from MUFJ. At that time, Lehman Brothers. 2 weeks after, we had $700 billion in 50 billion. What will it help? We could have gone down in a day or two if the confidence people lost.
Was Morgan Stanley bought by bank? But what is it?
They were not bought, MUFG infused
money.
Oh,
to buy share.
Nice way of saying things.
Yeah,
I
well,
see
what
it.
I'm trying
I like
to say
it.
is they
Politically
give 50 million.
correct.
They give a little check.
Yeah.
If you really look at the math, that check doesn't change the exposure. That doesn't change the possibility of the if actually it collapsed, it would have collapsed. But the confidence that they have some liquidity kind of let it survive. So it's only confidence. It's not real math.
See,
Never real math.
when Titanic was made, nobody thought it will sink. Just few holes, something went wrong, it all sank down, right?
Mhm.
That's why like when Lehman initially came, nobody thought it's too big to fail. Because it was so big, people thought it's too big to fail, it will never go down. That false confidence, government had to see the collateral damage before they said, okay, now we have Merrill Lynch, we have AIG, both are going down now. Who to save? They said we need to put money to AIG because if insurance gets affected, that's even more catastrophic. Versus Merrill, they said, Bank of America, can you come in, get a better deal, take it up.
It's safer.
So when they had to make a choice, because initially people didn't even think that Lehman will go down, but when it went down, it just opened the eyes.
Yeah, nobody talks about Bear Stearns. That's another one that disappeared.
Yeah. Bear Stearns had its own story. People were playing bridge. Like somewhere when this whole was going down, the CEO was playing bridge. Right? So he never thought this would happen.
Yeah.
Right? But if you see Lehman, like when, and the bigger problem with Lehman versus LTCM, LTCM has a short, everything had a like liquidity squeeze. Even if you look at Archegos, we'll come to, which is the most recent. It starts with one counterparty going down, but you still need to meet obligations, the other person.
Mm-hmm.
As multiples start going down, your liquidity is gone. So it starts with that. It's like ship, little water will come, more water will come, then it will sink down. Right? So with Lehman, the problem was, like as Prashad earlier said, they had contract with multiple people. I did contract with Alexi. Alexi took my contract, did with Carlos. Carlos did with Matthias. But at the end, I didn't know who I'm facing. Like you were saying, oh, I did not get the money from here. He did not get the money. Like that's where all the clearing started. Right? So they started like, you know what? We need to clear this well. Right? So like this person facing this person, let's pull all the contracts. Let's have a hub. Let's start clearing what we can do. At least that will remove the bilateral risk. But that introduces another risk. Now you have a CCP in between. What if that goes down? Right? But so again, they're trying to make it more transparent, but making sure those things are visible when something goes wrong. Government know where to put money. Will it be AIG? Will it be Merrill? At least they know the context, how much money is. So that's how this was a game changer, Lehman. And this brought the counterparty risk to the forefront. And that's when I would say initially people were talking about this, they will put it into credit risk, market risk, but then it became a risk stripe of its own. Okay? Then AIG, same time. And then the most recent was Archegos, which led to the evaporation of Credit Suisse. Right? So again, with Archegos, they had too much concentrated positions. and when everybody started calling, those positions they did not have the funds now. Like Credit Suisse lost 5.5 billion. Nomura, again, just one counterparty went down. You're looking at 10 billion losses. Imagine if it cascades. You're trying to evaporate some portion of your GDPs. So, what do these crises have in common? Let's talk about what do we think in this crisis? What is common?
Liquidity.
Good answer. What else? Yeah.
Say it again.
Counterparty risk.
It was a false belief
That's right.
that they would be reimbursed from the thing went bad.
Yeah. Systemic risk.
And also trust is related to the contract operators.
Yeah.
Maybe they stop lending.
So they everyone had leverage, right? To that so counterparty credit risk on its own never starts the down spiral. It starts with one counterparty not meeting obligation, and then it becomes contagious. That's like a nuclear reaction. Like what happens in nuclear reaction? One will explode, then thousands, millions will explode. Right? That's the risk. Not like with any other bomb, but with nuclear, because you trigger a chain reaction. So now we know. So going back, so we know. So going back one slide, Prashant. So we know why CCR matters because of the market size. We know why CCR matters from the financial crisis that has happened. Not what could go wrong, what has actually went wrong.
Sorry, the three company you mentioned was so it was Lehman Brothers, Goldman, and Marriott, right?
LTC.
The three you mentioned.
Top, right? At the time. Goldman, like, if people will say what I want to start, like 2007, there was a Goldman number 1, Merrill, Lehman number 2, Merrill number 3. 2 out of those have evaporated. Like
Now what companies are those?
Right?
Still Goldman, right? But then JP Morgan?
Now, which I have most respect again, like those are my personal views, right? Goldman number 1, the reason I will tell you, it doesn't matter who starts at the tunnel. Think as like these firms as tunnel. It doesn't matter who starts on one side, when they will come out, they will all be same products because they know their stuff well. Very like military. Like when you go to the military, they will shave your head. They will make you all unique. Like you will bring your own skill, but at the end, it will be all like how unpolished you were, what background you came from, doesn't matter. Because you have gone through the grind that will create a consistent product and that will be top of the shelf. Goldman is number 1. JP Morgan is very good. Morgan Stanley is very good. Credit Suisse was very, very good at one time. The best thing about Credit Suisse, the people they had, and most of these banks, not about like the balance sheet, the people that work. They were very good at finding creative solutions.
Like helping mafia guys, you know. I launder their money. I like it. That's what.
Yeah. So
that's what Credit Suisse happens.
Yeah.
Actually, that's a cool story.
Yeah.
By the way.
Yep. So let's go to the next one. Okay. So we talked about initially when we were talking about credit and counterparty credit risk. In credit, we said there's loan, mortgages, bonds held to maturity, right? And when we talked about counterparty credit risk, where this will arise, will be one derivative. We talked about in derivatives again. Over the counter is what I showed you, 850 trillion. But then there's this world, clear and exchange traded as well. Add more. I just gave you the, like not tip, like the bulk of the iceberg, but there's more to that iceberg, clear and exchange traded, right? Because in derivatives, you don't know which way the market will move in this case. And again, second is security financing transactions, right? That's big in the market. What they do is, a lot of banks need funding. They're holding a lot of on their balance sheet, let's say US treasuries. Now, what you will do is US treasuries, you will say, I need funding to run for my working capital. I will lend this US treasuries, give me cash, I will pay you rate of interest, but it's secured. Because on one side you have given them securities, on the other side you have taken cash. But what can happen is the cash that you are holding is worth less if the securities appreciate, and the person does not give you the security back. Right? So in that case, it's a security financing. It's still secured because there's a cash leg and there's a security leg that you have pledged, but there could be a differential between the two that can lead to that loss. And then you have security borrowing and lending. You say, I give you US Treasury, you give me corporate bonds. I give you NVIDIA stock, you give me Microsoft stock. But not both will move in the same way. If I'm holding Microsoft stock and I've given you NVIDIA, it may happen that NVIDIA has gone down, Microsoft has gone down, my risk has created. And now if you don't return my NVIDIA stock, I'm holding on to something, Microsoft, which is worth less. Right? So I have a differential that I have to manage. Right? Because starting today, again, going back, there's a financial contract, which is like this securities financing contract. The market's value change, obligation is created, and the counterparty's ability and willingness to meet that obligation creates a risk. Right? The same concept will apply to derivatives, same concept will apply to security financing transactions, and same concept will apply to traded but not settled products. Very similar to FX forward. Traded not settled, I talked about the structured note, where the settlement will be in 10 days, but the counterparty does not show up because that product has gone down in value. Right? So we are on slide number 11. So I think maybe I want to start with the next topic, Vishal, because I do want to make it digestible. I know we went through a lot of content today, but I want you guys to start having, first of all, if you go out of this class, can I spell out counterparty credit risk for someone? Think about it. Right? Because if you're going for getting into industry, at least one thing you can take, yeah, I can define counterparty credit risk. I know why it's different from credit risk. Right? Where it fits in the picture. I know why it matters. So every class try to take 3 things away. Like if you want to answer from this session, what 3 things you can answer? Do I know counterparty risk? Do I know why it matters? Why it's different from credit risk? If you can answer those 3 questions, and I'm going to ask in the next class, at least that is a good takeaway. Not like everything, but at least that will be a good takeaway. What we can do, and I want to make this first class light so that you can digest. So the next time you come in, you go through, and these slides I think Prashant will upload into Haskell, and you can go through it, and we will start from slide number 12 next time. Right? If you go back to the outline, I do want to give you some, so go up, references, Prashant.
Oh yeah, the book. Yeah.
So I want to give you 2 books to, like 1 book. So this, so actually, John Gregory, he is known like informally, not the father, but the father of counterparty credit risk. His books are the best read. So think these as the Bible for counterparty credit risk. So it has many editions. So I think I refer generally to the 4th edition, which is the latest. So if this is the book, I think what you should refer if you want to learn. Again, I'm going to give you tools, right? Not everything you will be able to grasp in like 5 sessions, but what will be good is if you want to start referencing something, this is that good book. There are many, but this is the best book. Even today, I open, it's like Bible. You read over and over again, you will find something new. Oh, I missed it last time. Right? So this is that good. Right? And then if we scroll down, yeah. So we talked about why regulators care about, because it's a lot of contingent risk. So what they did once in 1110, SI 1110 means this was published in 2011, right? So after the whole Lehman went down, AIG crisis happened, Fed said, you know what, we learned a lot. Let's put together an industry guideline. If you want to start doing derivatives, security financing transactions, type of trades, you need to show me that you have capability to manage your counterparty credit risk. So this is the guidance that in the US, this is any big broker dealer, Goldman, Morgan Stanley, they will go line by line and they will start saying, do I meet this criteria? Do I meet this criteria? Do I have this capability? Do I have this capability? That's one. Then once Archegos happened, 2021, right? They also again they published something. They said, guys, you need to start looking at some of these hedge funds, which may not disclose you all the positions they have, but the problem you're gonna run into with Archegos is they were holding the same position with everyone, right? Now there's a crowded concentration risk because everyone is calling the margin at the same time, give me money, and now it's just gonna sync their portfolio holdings. So they came up with another guidance, 2119 in 2021, and then very recently, after these two, like Basel generally is a global organization, what they did, they came up with a new guidelines on counterparty risk, saying US is US, but we want to make sure counterparty risk is being managed consistently across the globe, because there's a risk it can sink the ship like Titanic badly across the globe, right? So these are the three guidances, like which, like again, not for now, but you guys should be aware of. If somebody talks counterparty guidance, yeah, I know there's regulatory guidances. There's SI 1110, there's a SI 2119, and there's a BCBS guidance. At least if you can talk this, then you know you are serious enough to know the subject. If you go back to the slides, and from the first book, if you scroll down to the last slide. So over here, in this class, what I've been focused on was mostly your chapter 2 fundamentals. Again, I don't go the textbook style. I'm more coming from practitioner style. But if you want to read about fundamentals, that is your chapter 2 in 4th edition, which I said. Chapter 2 and chapter 3, you will find good information which you can always refer. Again, go with the intuition first, supplement with all this information, but at the end of the day, you should be answering a few questions, and that's why I want you to start building intuition. Right? If you go scroll up, maybe I think, and once you will complete this chapter, I also know go down with the mind mappers. Mind map, yeah, just a minute. So this is how, if you want to remember a lecture, remember like this, right? So what we covered, a real life example, a house flip example. There was a contract value that changed. Counterparty may not perform. We translated that to FX forward example. We went to a CCR definition. We talked about why CCR matters, both from market size perspective and the crisis perspective. And then we talked about different products which have the CCR risk. And then we will talk about risk management in the next class. Okay? But at least this way, you can remember mentally what we talked about. Any questions? More than happy to answer. No, this was, I really appreciate. I think there was a lot of interaction. There's a lot of good engagement. And I think that is best if you're spending 3 hours of your day. It's not, I do want you guys to take away something. Because I value your time, right? So, and even I'm coming after, like I woke up at 5:30 today. So my mom called from India. I woke up at 5:30. And then I was in office, I reached office by 8. And then I was like till 6, 5 there. And then I came here because I do value, like you guys coming up, you should learn. Because if you are spending so much time, so much value of your day, at least if you go after this class, you should read about this. Like maybe I think this is how ChatGPTs come into play. If you start putting this into ChatGPT, can you give me some more? Maybe it will take 30 minutes, but you will have sufficient information where you can walk the talk whenever you get into your career. And you never know how these things will come handy. Because looking forward, you cannot connect how CCR will play, but maybe down the line, 10 years down the line, you know, I took that class, I read about it in ChatGPT, now my career connected. Like that's what I say, when a friend stayed with me, I never knew I will do MBA. Had he not stayed with me overnight, had we not have a conversation on MBA, I would have never taken GMAT, would never have come to for MBA, I would have never made my career in finance. So these are accidents are meant to happen, and and that's why when Prasad called me last week, and he told me after this whole long weekend, on Wednesday he calls me, he said, Gurpreet, and I was in a committee meeting. He said, Gurpreet, can we talk? I said, yeah, let's talk at 11:55 a.m. So we spoke. He said, can you teach this course? Like I said, when is it? I thought like it's every month or so away. And he told me starting Tuesday. Right? I said, wow. But again, you have to always stay open for the opportunities. Like it was very easy to say, no, Prashad, can you take it? I will help you. But you always need to stay open to opportunities because you never know how they will connect when you look backwards. So with that, happy to answer any questions.
And anything, he just unrelated topic. He just mentioned AI. You guys should connect on LinkedIn with both of us. First of all, we are practitioners. We are not lecturers. And I wrote an article on how 2 of you are operational risk. You said you're interested. how operational risk will change in the future. I wrote an article about a week ago.
One apology. Can you put it the first slide, please?
Yeah.
So I can, you know.
Oh, relate to what I'm talking about.
NFR. Don't go up NFR. It should be a
Yeah, NFR. I mean, NFR is a fancy word, but I'm talking about this only in this context. I'm not gonna bore you. Operational risk. We've been doing this from 2023 onwards. It's a particular structure that we use in the non-financial risk. I wrote an article to dramatically change how we execute operational risk, and I published it about 10 days ago on LinkedIn, and it's gone viral now. Apparently, I'm the top 1% performers on LinkedIn, and that was my first post.
Wow.
Yeah.
You never know
I
how that
never
will
thought of
translate
that.
into career.
Anyway, so connect and read the article, not unrelated to this class, but definitely related to your ERM class, which you will have to do this fall. So that's that. And again, I wanted to talk about this non-traditional. We both pulled into this last week. It's not traditional, so I don't know what you'll grade when you have to grade end of the class. I have no idea. But please do understand that we had to do this in a very short, unexpected thing because they called us on Wednesday. So this non-traditional couple teaching, I hope you guys are okay with it. Please don't complain about it. Okay?
No, this was good. You brought like outside experience, so that this is really
Yeah.
good.
So all I'm saying is this is not traditional. Take it with a little bit of be a little bit. I mean, we're not doing this in the dark. University knows we're doing this. They let us do it, but it's kind of weird that there are two professors for one course. Anyway, all right. If you have any questions, we'll answer. But we're gonna let you off early today.
Can you put the very first slide, please?
Yeah. This is not the first slide you wanted. Okay.
No, this one's also good. It's good.
Yeah. I thought you were.
Go back at the house flip.
No, your name, so I can.
Oh.
So I can. Oh, where's? Yeah, that one.
Yeah. I'm a die-hard F1 fan, if that matters. And he apparently enjoys golf and cricket.
And enjoying life. There's no other option.
Yeah, I actually started learning golf about 5 weeks ago, so I'm taking lessons right now. Anyway. Oh, you want to look on LinkedIn? Okay, now I got it. All right. I had a beard. I shaved it off last week for the class, so I'll look different on LinkedIn.
I think we will talk towards as the course progress. I will also talk how I'm rolling out AI at SMBC for CCR. That will be fascinating. You know how we use this as practitioners. Right?
Likewise, me too.
Right?
So.
And two, even after if you guys have any questions, feel free to reach out. You can connect me with the LinkedIn. Even after the course, if you guys anytime you want to come, I'll be happy to bring you.
Don't offer too much. He'll say that, but he'll be busy 20 hours a day.
But there's always a connection.
Yeah.
I look at as a hindsight, in 2008 financial crisis, in perspective of counterparty credit risk, how would the regulator should do better? Just briefly, what they could do better or they did a good job?
Oh,
I want to hear from you.
No. I mean, I think there was a little bit of, definitely there's counterparty credit risk regulations, which I'm not familiar with, but generally for that financial crisis thing, Dodd-Frank was put in place after that, right? I really thought Dodd-Frank, they went extreme. A pendulum always goes one way and the other way, and they removed Dodd-Frank. But the beauty of Dodd-Frank was that they expected every bank to give their transaction information. Not a report, not their interpretation, they actually wanted them to give the underlying data. So with sufficient, they had to upscale themselves. The regulators didn't know all this before the financial, but upscale, they can actually do all kinds of analysis and understand where the risks are. With Dodd-Frank, I thought that was beautiful. And then first Trump administration removed it. So Silicon Valley Bank happened. I'm not saying that's a direct relationship, but if they had those exposures, maybe they could have called on them a little bit ahead that your bonds were not hedged. I don't know, but that was a good
So
thing.
practically the financial institution gave actually the raw data, so different analysis could be run on that.
Yeah, not just what you're saying,
Yeah.
but you got the data.
Yeah, so the original, not
The,
the
not the
one.
interpretation. So that was Dodd-Frank, and we were really disappointed that went away. Although that said, in Dodd-Frank, that was just one of the features. There were a lot of other painful burdens that we're happy they left. But anyway, but CCR, this is general.
Yeah, so I think again, you can imagine if you have I-95, you have no speed limit, like derivative world that was before.
There is no
2008.
speed limit on 95.
Right? So if there was no speed limit, you could see how many accidents could happen. What Dodd-Frank did, it imposed a more strict limit, maybe 40, which people will not like, but at least that will tune your mindset. And then the new government will come and they say, yeah, let's give them 65, right? So that's how it worked. So as pendulum shifts, they tried because they were burnt badly. They had to take people taxes and feed these banks, and people were saying, why are you taking my taxes and feeding these banks? So they had to put some strict, like 40 limit, and they said, you know what, over time, as they will start getting wide, we will relax it slowly, and now it's coming back to 55, 60, 65, but I don't think they will ever take the speeds up, because that will be very political disaster as well.
By the way, I just read somewhere last week, the speed limit in New Jersey is a group decision.
It's a group decision?
What that means, if all the cars are going at 80, better go at 80.
So
Don't
that's
challenge
what-
that. It's a group decision.
But that's what I'm
Everybody-
saying. Even it's in Connecticut, it's like you drive. The rule is apparently is like you drive like everybody else drives, as long as you don't.
Yeah, that's it. That's why it's a group
As long as you
decision.
don't
Be a team
race.
player.
As long as you don't race, like
don't
that's
mess
the
with them.
I think with that whole auto lane, auto cruise, that helps.
Yeah.
Because you can find a fast car and you can let me just tail
Get
it.
behind.
Yeah.
Especially if it's a police officer, it's the best.
Yes.
So yeah, I mean, again, we let you off early today because we both have to drive 2 hours. We drive here 2 in, 2 hours out. So 4 hours of driving, we have a class.
Thanks to you.
And he's getting paid nothing. I'm getting paid something here.
2 hours from
You
where?
don't do this for
Going home now, 2 hour drive.
Thank you.
From where? What part of Connecticut do you live?
We don't live in Connecticut. We're coming from New Jersey, Jersey City.
Oh.
I live in Jersey
I
City.
feel
you live in
I
I
feel
live in
sorry,
New York, I
by
get it.
the way.
What?
You live in New York? Ah.
You want to ride back home?
Let's go right back home.
Wow.
No, I
Did you-
gotta drop him off.
And then you have to pay the tolls going home too.
Say?
You gotta pay the tolls going home too.
Yeah, I go today, so it's fine.
I came directly from office, and he picked me up from Stanford station. Next time I think I'm gonna come because I was in office today.
Yeah. So anyway, so that's our story, but we'll be happy to answer anything you need, and again, I apologize for this non-traditional class, but we had to do it. I mean, if we didn't take this on, I don't know what they would have done. They didn't have a lecturer for this class, so the dude couldn't make it last minute. Yeah.
I have a question though. Why are you saying that he's not getting paid? Is he actually not getting paid?
He's not getting paid.
He's not getting paid. I'm not getting paid either.
What?
I mean,
What?
I'm getting paid enough for the tolls and a dinner.
It's also a volunteer
Yeah,
experience.
so let me tell you this, I don't know the actual math, but what they're paying us is probably 0.001% of our total income, so it's not nothing. That's me.
Okay.
He is not getting paid anything, he's a guest lecturer for this course.
Thank you for
The reason we did this arrangement was because from Wednesday to today, they can't even onboard him. Because New Jersey, because this is a state school, UConn is a state school. If anybody teaches from outside the state, they have additional documentation to why they have to teach, why you have to hire an out-of-state person. Why can't you hire an in-state person? So that would take at least a month. So we couldn't onboard him. I'm already onboarded because I am a lecturer. So they put me on the payroll, which is, again, peanuts. And I said, he's gonna come and teach. They said, yeah, that's fine. So.
No, it's generally I do this at my alumni. Simon School of Business, University of Rochester. I will go sometimes like once in 2-3 years because I want to pay back the people who made me this. So it's always good to come to another university where you can build that connection. That way I think it's always good for your own, like you meet people, you expand your whole horizon.
So it's a very good favor he's doing. That's all. All right.
Round of applause.
Thank you. Thank you very much. We'll be here for 5 weeks, and whoever's doing the fall course, I'm teaching 2 courses, 2 days a week. So, all right. Let me figure out if I have Husky. If I don't have Husky, I'm going to upload to one of my old classes. I'll keep it there till they give me access to your class, and then I'll try to do it over. Okay. And the same thing with the syllabus and everything. I'll
Just
probably upload it over the weekend.
No.
By then, I think everything will be okay, but if not, we'll figure it out, okay?
So total report, I don't know, but this is the.
Yeah, but if I don't have Husky, I don't even have the retail ID. So Husky CT, I think they'll send it to you.
Right, but we are the market.
Yeah.
In general, but
Give it to someone.
No, it's definitely, I'll get Husky access today.
Pythia,
It's
Pythia.
on today, but
I recorded it.
Sorry, what?
I recorded it. It'll be on YouTube tonight.
Sorry?
I recorded it. It'll be on
Thank
YouTube
you.
tonight.
We are just saying about the like PowerPoint and like the
Yeah, Pop.
that stuff.
I recorded the other thing too. I don't know if there's any sound. I don't know if there's going to be any sound with this because I have the computer muted.
Oh, I actually recorded this, so I can also share this in the share folder.
Yeah, but that's recording right now. But I don't know if I'm going to get any sound because I have the computer.
Yeah,
muted.
it's fine. I also recorded. I use my computer at home and asked my friend to record it so definitely with sound. Obviously, it's definitely with sound.
And don't buy that book. Let me see if I can find that book first.
Yeah, I
I'm
can
pretty
also
sure.
try to like.
I'm pretty sure I can find that book. I know I have it through Vital Source, but I'm pretty sure I can find the
Thank
PDF.
you.
So don't buy it till I say, okay, just finished up.
HPP, Hudson Pacific
Oh, yeah,
Properties.
yeah,
I think
On the A lab, you
Oh, did it check in a while?
It's an automated trip.
Usually that's what we do.
But will it show to all of you or just me?
You have
You show everyone, right?
No, he has to share intros now. Remember what all professors are doing?
No, but if she, Christine is on the job. They must share. Yeah, that's what the chat didn't say yes. Oh, okay, then after 24 hours I should upload.
This is
Computer, that's a problem. And this is not even my login. Yeah, by then, yeah. If I lose it, but we'll see. I'll send it. But next time.